I know, we get to
Can't
sing
see it.
first.
Well, good afternoon. Welcome to the Global Conference panel on the privacy and pitfalls of private equity. I'm Mark Tierfelder, co-chair at Deckard, and it's an honor to be here in front of all of you, and it's certainly an honor to be here with amongst the brightest minds in the world of private equity investing today. All the way to the far right of the stage is Joe Barata, Global Head of Private Equity at Blackstone. Next to him is Anne-Marie Fink, Chief Investment Officer, Private Markets and Funds Alpha at the Wisconsin Investment Board. Patrick Healy, Chief Executive Officer of Hellman & Friedman. Jonathan Sokoloff, Managing Partner, Lennon Green & Partners. And Pete Stavros, Co-Head, Global Private Equity, KKR. All right, well, let's get started. There's a lot of noise out there in the world today about the state of the private equity markets. Even the title of our panel, The Polarities of Promise and Pitfall, set us up for a decent conversation, I would hope. Somebody came into my office the other day and asked, should I be thinking about private equity today the way I think about O'Hare on a snowy day? That is, planes circling around and around trying to land, deals that are yet to exit, and planes backing up on the tarmac waiting to take off, trillions of dollars of capital waiting to be deployed. Joe, why don't we start with you? You've got a spot at the top of the air traffic control tower. Am I going to be able to make my connection, get back to New York and see the Knicks sweep the Pacers? Or am I going to get stuck in the air?
You got to be patient. You know, maybe the flight's delayed, but you're definitely going to get to the destination. We've even in this environment, after the kind of market turned down at the end of Q4 21, we've invested well over $10 billion in our flagship funds, mostly between the summer of 22 and the summer of 23, which was a particularly good time to invest. So in terms of being able to take off, with no credit market to speak of, with sort of equity markets at their nadir, we were able to, I think, manufacture some really good investments, as of the other people on the panel, in that moment. In terms of exiting, I think amazing strategic exit from Leonard Green with one of their big investments. Patrick sold a big company to a public company. We've been able to realize about $20 billion since the end of Q4 out of our portfolio, largely selling public stocks we had in public companies, a strategic sale or two, selling things to our competitors. So I view the market we're in as normal. I mean, I've been doing this for a long time. There are cycles. If you look at the liquidity from 2008 until 2012, you weren't going to see a lot of distributions in that period. So I think we're actually in a better moment than that, and I feel highly confident in our ability to continue to deploy capital in the way that we have and return capital. It just got a little stuck there. People invested far more money than maybe their LPs anticipated in that 2019 to 21 period. It'll take a little time to clear that out.
That's great. Jonathan, going back to Joe's point about 2008 to 2012, 2012 was the start of a very long bull run in global M&A markets. How are you thinking about things from where you're sitting today and what you're seeing? And tell us a little bit more about this great exit.
Well, thank you for having me today. And my career goes back to the 1980s when I worked with Mike Milken at Drexel Burnham, and we borrowed money at 12 and 14%, and the world was very different. So it's important to remember that private equity is a very cyclical business. And we had kind of an up cycle from really 2010 to 2021. So we had a 12-year party that was a lot of fun. And if you didn't do well in private equity in that period, you're probably in the wrong business. But then the party ended, kind of boom, and the music stopped really early 2022. And it was a rough couple of years. And that's not fun, but that's okay and normal in our business. And we went at Leonard Green 18 months from early 22 to mid 23, and we didn't invest a single dollar. it's hard to do nothing. We're not wired to do nothing, but that's what we did. And then for a variety of reasons, we saw things pick up in mid-2023. So mid-2023, we saw multiples finally coming down from kind of the 2021 levels. Earlier this year, we saw the credit markets open. So roughly, we were borrowing in the good times at kind of 6%. All of a sudden, we woke up in 2022, and that was 12%. And that means we couldn't find anything to buy with 12% capital, so one of the reasons we didn't do anything. And now that cost is back till about 9%, so we can transact there. But what we're all still waiting for is the equity markets to recover, to be a source of capital raising and exit for us. And they really aren't, and we can talk later about whether the equity markets are broken, dysfunctional, or unreliable. But I think I think we're all finding interesting things to do to deploy our money now. But the industry has, depending on who you ask, 3 to 6 trillion in the ground, and we have to find a way to get that back to our LPs like Anne Marie, and that's still a challenge. So holding periods will lengthen, it'll be tougher. We've been through cycles before, it'll be okay, but the numbers are a lot bigger now, and it's going to take a while.
Well, my family motto at home is putting the fun back in dysfunctional, so I'm excited to talk about the public markets with you on that topic. Pete, let's turn to you. In your mind, is PE positioned to continue to perform well? And how do you think about timing and cycles and when to put investment dollars to work, make allocations?
I think the most important lesson we've learned is not to try to time the private equity market. The landscape is littered with people who have tried to do it. We, in 2005, 2006, 2007, we thought the economy was stronger than it was. We over-deployed, and then we didn't have enough capital to take advantage of what was a really interesting environment post-recession. So whether you're an LP or a GP, I think the smartest thing you can do is evenly deploy your fund or your capital over on a linear basis, and then outperform not by trying to time the market or pick the right sector at the right moment, but picking, if you're an LP, the right managers, the right asset classes, and in our business, picking the right assets, picking the right CEOs, and driving operational improvement. That's the way you can sustainably outperform, in my view. Now, so acknowledging, I don't know if this is a great time to invest, which is why we do what we do. If I had to guess, I think this is going to be a period of some pretty interesting vintages. If you look at history, when the outlook for the public markets is muted, private equity tends to massively outperform, which makes sense because then you don't have, a rising tide lifting all boats, and that's when our operational improvement and the things that we think we're good at really shine through. Private equity vintages also tend to be pretty strong when capital markets liquidity are low. So when there are not a lot of IPOs, when there's not a lot of leveraged loan and bond issuances, that tends to be a pretty good time to print private equity deals, which again makes sense because if there's less debt available, purchase prices are constrained, there are better deals to be had. So, and then I guess the last thing on dry powder, one of the things I think people are getting wrong at the moment is, wow, there's a lot of dry powder in the United States. There's $1 trillion by some estimates, and that's up about 2.5 times over the last 15 years. But over the last 15 years, the S&P is up 5x. The Russell 2000 is up 3x. And then this, assets in the ground point that John Sokoloff just made, if you look at dry powder as a percentage of dollars in the ground, it's at a historic low. So it's not going to be great for some of the dollars that are in the ground, and if you overspent in 2021 and 2022, that's going to be a little painful. But for new money going in, there are going to be some amazing opportunities because of this imbalance. There's a lot of capital that's going to need to find a new home, and there's not really that much, dry powder out there on a relative basis. So if I had to guess, I would say there's some interesting vintages coming up, but the most important thing I have to say on this topic is don't try to time it because nobody knows.
Excellent. Patrick, we've talked a little bit about multiple routes to exits. Maybe you can give me a little bit of insight of how you're thinking about, from your playbook, different ways to get to market with.
Yeah, look, I think we're like I think the good news, and I don't want to, given my size, be the poster child for private equity. Did you get the joke, John? Anyways, look, I think we're like in the third inning of the institutionalization of private markets, and I think that opens a lot of, opportunities. And if you think about certainly my career, Joe, your career, I think, John, your career, we're all recovering bankers. We sort of, when we started, it was the deal business. So it was very much buy, sell, buy, sell. That was the model. I think sort of post the dot-com crisis, our industry figured out it's not about the deal, it's about the business. So we transitioned from the buy, sell to the invest world. And over the last sort of 10 years, I think private equity's not just the investment business, but also the ownership business. So folks have been owning things longer because we can, and as the private markets institutionalize, it allows us to own things longer while returning capital. So, in the old days, you could sell to another private owner, you could sell to a strategic, you could sell to the public markets, but today we can also now sell as these private markets institutionalize, sell along the way. So we just sold $4 billion of the largest private insurance broker in America called Hub. John, you came into the deal. We sold $4 billion of equity in between, some private equity, some institutional investors, and we're going to allow half those institutional investors to recycle every year if they want to buy or sell in a private context. So there's going to be liquidity. You don't have to sell all the businesses as we sort of move into more of this ownership phase of our industry.
Great. Anne-Marie, what's the LP perspective on our conversation here?
So I call some of these unnatural exits. So I do worry a lot. I do agree that there's a lot more ways to exit now. Certainly CVs, NAV loans, dividend recaps have been around for a while, but and secondary sales, things like that. So it is exciting that there are opportunities for liquidity as a result of that, and that we don't have to only rely on the public markets. What worries me, though, is that we haven't really developed the mechanisms such that if you sell off 70% of a business, now you're a 30% owner, how do I get liquidity on that 30%? Because at some point, I need liquidity because I have benefit payments to pay and other things. So, and I don't think the industry has really figured out, and I agree that there's an institutionalization that needs to happen around this, but I don't think the industry has yet figured out how we're going to manage some of that, some of those smaller pieces. I mean, I was talking to a GP about 6 months ago and asking them about this, and my apologies to everybody north of the border, but I asked the GP and he's like, don't worry about the Canadians will buy it. But that's not really, that seems more like a hope strategy. So I do think we need to figure out ways, particularly as we fragment the pieces and we don't get full sales, how to manage such that we don't get stuck forever. That's one thing I would say. And then the second thing I would say, particularly around CVs, continuation vehicles, is these folks are both a buyer and a seller in each of those. And they swear to me that they're always evenly right down the middle, a buyer and a seller. I'm not biased either way. Sometimes I think they really are more sellers than buyers, and other times more buyers than sellers. And so we can't rely, like we do in your fund business, on our interests being completely aligned. And so we have to build out, and we're working in it internally, we have to build out a capability to really be able to evaluate these CVs and whether we want to go along for the ride or whether we want to exit.
Anne-Marie, let's stay with you for a moment. You've got a front row seat looking across a lot of asset classes and a lot of asset managers, particularly in the GP space. Tell me how you think about the promise of private equity from a governance perspective and how that leads to value creation, and contrast it with the ownership model for public equities and related types of instruments.
Yeah, so one of the things that I think is most exciting and the promise, so I just talked about the liquidity pitfall. The promise of private equity to me is that you have just a much better governance model. You have far less of a agent principal problem than you have in the public markets. And so the ability of management teams to work closely with their owners, I think is generated huge returns, and it's a huge advantage that the private companies have. And I started my career actually as a public equity analyst, and I distinctly remember once talking to a CEO, and there were probably 4 or 5 of us around, and he was saying, how do you want me to return cash? Or what do you want me to do with my excess cash? Pay out dividends, buy back stock, invest in the company, make acquisitions, and he literally got 5 different answers. Whereas I think the advantage in PE is that each of these folks, when they buy a company, they create a value creation plan, and they stick at it for a period of time. Now, not forever, and if the management team's not working out, we appreciate your replacing them. But there is an ability to kind of see through longer term than what the public markets can do right now. And I do think the public markets have gotten worse over the last 25 years, right? So there's just a lot less liquidity, a lot fewer fundamental analysts, a lot faster holdings. And so I do like the private equity model. And we just have to, one, manage for the liquidity pitfall, and then agree on. Let's make sure that, well, what I would say on fees is we just want to make sure that I want you guys all to get really rich, but only if my pensioners also participate in the fruits of the labor.
That's great. When we start talking about fees, this is when the lawyers on stage start to duck. So, Pete, tell me about how you think about the governance model, the way you can use that to leverage the value creation that Anne-Marie was talking about, alignment of interest.
So our governance model in terms of performance, I think Anne-Marie covered perfectly. I think it's self-evident that it's a superior governance model in terms of driving performance in a company. I think the other opportunity is around the potential of our decision-making apparatus and our governance model of having massive impact at scale and quickly. So imagine we all set out a goal that we want to teach financial literacy to as many employees as we possibly could. We want to reach 10 million employees. Most of America is financially illiterate, so this is kind of an important problem. And in the public markets, if you were to try and make a dent in that, you would have to go to all these individual CEOs and convince all of them that this was important and train all of them, and they'd have to have their own efforts around that. And you'd probably be lucky to reach, 100,000 employees. If just the people on this stage decided, this is important, we are going to teach financial literacy to every employee in our portfolio companies, that's millions of people. So I think that's the other promise of private equity, not just better performance, but if we got it right, and I am not saying we're there, but wow, you could have just an enormous impact on the workforce, not to mention climate. And last thing I'll say is I don't think it's unreasonable for the public and the folks in Washington, D.C. to look at our industry and say, you employ something like 15 plus million people. That's a lot of skill. What are you doing with it? Like, what's the reason for being a private equity beyond just delivering returns, for your investors and yourselves? I think that's a reasonable question to ask. And right now, we haven't been doing the job. But I think if we can get our act together and pull in the same direction on some important issues, wow, we could have a huge impact.
With the efficacy of the leverage that comes from it, and consistent with the theme here of the conference, right, about visions for a shared future together. So, Joe, tell me about your view on the PE governance model and how it's sustained outperformance of the private markets relative to the public markets.
Well, I want to pick up on a thread from Pete. I agree completely that as control owners across a portfolio of, in our case, about 140 or so control companies and over 200 companies, including all the other investments, we can drive important stakeholder projects that are much harder for public companies to do at our scale. Of course, Google, Meta, whatever, they can drive things across huge population bases, but we're basically middle market public company size owners. And we're able to drive decarbonization efforts across our businesses. We're able to drive a systematic look, and this is one thing that we're doing in addition to the amazing work Pete and Ownership Works is doing on broad employee ownership, which we're also adopting, but we're really focused on trying to bridge the opportunity divide that exists in the country. So we started with 6 of our companies, we're now at 55, systematically looking at how they're recruiting, what the job requirements are for career-sustaining jobs. Do you need a BA degree to do a certain job? And trying to organically access talent pools that historically have not had access to career-sustaining jobs. So the idea that we can do that across 55 and hopefully ultimately 140 of our portfolio companies is something that a middle market public company just can't do. So we're proud of that. And I think that is part of the promise of the private equity governance model. In terms of driving investment outcomes, private equities outperform public markets for 40 plus years since KKR was like an innovator in this industry with doing really simple things on governance, building great boards, hiring the best management teams, being better capital allocators of a company's cash flows than pro-cyclical public companies tend to do, driving some degree of operating improvement, employing prudent leverage. Those are the structural reasons that everybody on this stage has built firms that can structurally outperform public markets, and that's not going away. And I think over the next decade, if you look at the last 10-year return of the Russell 2000, ended Q4 21, it was 13.6%. Today, that same last 10-year return is 7.6%. I don't think the Russell 2000 is going to compound a lot more over the next decade than it did over the prior decade. Our job in being able to meaningfully outperform that kind of public market performance, I think is not going to be that hard by deploying those good governance practices. And then we've all built operating intervention capabilities that are going to allow us to drive better margins, better organic growth. Hopefully, that's the intent. So I feel good about our ability to continue to do what we've all been able to do, what this industry's been able to do for 40 plus years.
Terrific. All right, well, let's shift a little bit and go back to where Jonathan led us at the top of the talk, talking about our public markets broken. I'm not convinced that's true, except when I maybe look at my own personal investment allocations. But we maybe need some new solutions if that is in fact true. Pete, what are you seeing out there?
And if it's true, Joe and I are in trouble because our firms are public, so we're hoping the public markets aren't totally broken. Maybe I'll just pick up on what Joe said about the Russell 2000. Most of what our firms do is we invest in the billion enterprise value range to, I don't know, 3 or 4 billion. There's the occasional $10 billion deal, but most of what we're doing, if you compare it to the public markets, is small cap or the low end of mid cap. So it's the Russell 2000, basically. So now you think about, would you rather be in the Russell 2000 or in private equity? Look at, so there were 8,000 public companies, I think people know this, there's now 4,000. So the public markets, have kind of been gutted. That has had a disproportionate impact on that Russell 2000. Great companies in that size range are deciding to stay private. Great companies have gone private and have stayed private. And so if you go back and track over the last 15 years, the quality of the Russell 2000, it's massively deteriorated. So return on equity has gone down, return on assets, margins, growth. It's just a less attractive portfolio. And if you look at those same metrics for the private markets, for private equity, all those metrics have gone the other way. So we're buying better businesses. Then when you add on top of that everything we've discussed about governance, where we can pick our entry and exit points, we pick our management teams, we drive operational improvement, we try to build these special cultures where all employees are rowing in the same direction. I just think it's a far superior proposition to be in private equity than to be a passive investor in the Russell 2000.
Well, and we're going to talk about it a little bit more later, but the theme on building special cultures and doing good while doing well for your LPs, I think is something that's fascinating to talk about. Jonathan, you started off talking about when you started your career at 12 to 14% interest rates, back down to effectively at 6%. Now we're floating at 9%. As you look across interest rate curves and yields and changes over time, your view on private markets versus public and whether the public markets are broken in different credit cycles?
Well, look, as I said, private equity's been around 50, 60 years. I think we've consistently outperformed. We're much less volatile in our performance. Some people question our marks, but if you have a S&P 500 mutual fund and one year it's up 25 and then it's down 30 and you're up this, it's just kind of, the public markets tend to overvalue things in the good times and probably undervalue them in the bad times. But, we live in a very creative and inventive industry, and we will find ways to exit our companies. If you do draw some analogies to the bank market, the credit market, because of regulatory issues or whatever, the banks didn't stop becoming lenders and they became moving companies. They just moved paper, from the borrower to the buyer. And that's a market that has supply and demand, gridlocks, and then all of a sudden you can't borrow any money. So the private credit market comes into place to fill that vacuum. And in the private equity world, we are very dependent and will be dependent on the public equity markets, but as they remain unreliable, we will find alternatives, whether it's, as Patrick said, high net worth channel, sovereign, continuation funds. Continuation funds, I think, are a permanent part of our ecosystem. They're an interesting tool to have in our toolkit. They will always, in my mind, be a small part of what we do. Because don't forget, when we, the GP, sell a company to a continuation fund, we don't get paid. We are asked to crystallize and roll whatever economic gain we have in those companies. And the truth is, private equity firms like getting paid. People like getting cash, and you don't get any cash from them. So that in and of itself will mean that continuation funds can't take over the world because nobody will ever make any money. So there's all kinds of things we're going to have to come up with to counter, this challenged equity markets. And right now there's two big competing tensions in our industry in that we work so hard to get control of these companies, we work hard to make them better, and there's a trend in our industry, you want to keep your good ones longer. Everybody wants to keep their good ones longer, and there's different ways to do that. Just hold them longer, sell them from one fund to another, do a continuation fund. At the same time, we're having unprecedented pressure from our LPs to send them cash in a vanilla way. And our view, Anne-Marie, is we'll send you cash any way we can because that's what you want. You want the cash. So the tension is we want to keep our good ones. We want to send you money so you can give us more money when we come back next time. We want to sell stuff where we get paid, but we want to keep our good stuff. There's all this stuff going on that, out of all this, we'll be fine because we've been fine for 50 years, but there'll be real bumps in the road. And right now there is a logjam, and the public markets are really causing the logjam, and we're going to have to figure out how to break that logjam through them or other ways, and we will figure it out because we're really good at that.
I think the key is just not to ask Anne-Marie which of the 5 ways she wants to get that money coming back.
Any way is a good way.
It depends. Like if I get a little bit back now, but you've levered the whole fund and I've cross-collateralized all through a NAV loan.
Agreed.
And I eventually lose more money, that's not a good way for me to get my money back. Or if I sell off a piece, but I'm never, ever getting the rest of that capital back, that's not a great way either. So I do think that, and I know you know this, right? So there just has to be a balance in terms of how we do this and how we develop, because ultimately, we have beneficiaries we need to pay. Other people have other needs for the capital, so it can't be in perpetuity.
We had a situation where we did a continuation fund at the end of last year, and we had sold, to Anne-Marie's point, 70 or 80% of 3 companies in the good times. And for a variety of reasons, we wanted, or the buyer wanted us to keep 20, 30%. We thought we'd get out in a few years. We weren't going to get out in a few years. It looked like the whole period would be dramatically longer. So we put those in a continuation fund and got you a cash bid at par for these little stubs that we couldn't get out. So that's a good use, I think even you would admit, of a CV.
We can talk about that fourth position. But
Okay.
anyways,
I guess
yes.
he's not fundraising.
Yeah.
no, that is a good. It is a good use. I mean, but you raised another thing that, I've had GPs come to me and say, well, we bought 60% of this company actually, it was probably more like 70, 80%. So let's say we bought 80% of this company, but we bought it from another sponsor. The selling sponsor loved it so much, they rolled 20%. Well, we happen to have a relationship with the selling sponsor. And so we called them up and said, so what's going on here? And they basically told us, yeah, we would have sold 100% at that price, but they wouldn't basically let us sell 100% because they wanted that marketing statement. And so that is what I talk about when I'm not, like, when all of this stuff is happening, it's hard for us to figure out exactly, whether you're more a buyer or a seller. So, and I think one of the results of that is going to be we're going to have to develop our own capabilities to value deals much more than we do now. Now, we do co-invest, so we already have some capability around that, but we're going to have to develop it even further.
Well, Amory, you should feel confident, just as our industry learned to get out of the deal business and get into the investment business, and it's all about the business. And our industry will relearn, Pete, the example you gave earlier, which is like vintage risk diversification, because we invested over this last cycle super quickly. People are going to totally understand that investors want to meet their money, so we'll work on it.
Yeah.
And it'll get balanced, and as we sort of develop these tools and techniques, people get that.
So let's continue on the theme of liquidity. The latest bumper sticker banging around the private equity world is that DPI is the new IRR. Jonathan, let's start with you. Tell me a little bit about your insights into that and how you think DPI.
Yeah, so the DPI is actually the cash money you send back to your investors, and people want DPI today. But IRR is an issue. IRR is a very heavily utilized calculation in our industry. It's a somewhat weird, mathematical, somewhat manipulatable calculation. But simple math, if we buy a company and we sell it, we grow it and we sell it in 5 years, and we get a 20%, we sell it for $100 and we get a 20% IRR and a 2.5 times our money gross. That's a nice business. That's kind of probably what most of us here underwrite to when we commit new capital. Well, if you sell it for $100 in 5 years, great. If you sell it for the same $100, back up. One of the other trends happening in our industry to all of us is meaningfully longer holding periods. We all kind of underwrite to 5 years, and that's not happening right now. So if you sell it for the same $100 after 6 years, your 20% IRR goes to 17. If you sell it for the same $100 after 7 years, your IRR goes to 14 gross. So that's kind of 11, 12 net. We're not in the 11, 12 net business. So one of the things we're all fighting is this tremendous extension or lengthening of holding periods because of all the reasons we've talked about. So how do we on this panel mitigate that and continue to delivering returns that hopefully start with a 2, is we have to say, hey, we can't fight the tape, we can't control the exit market, but we have to use our skills and just continue growing the companies because we're a better governance model, because we make the companies better. And so if instead of doubling the EBITDA after 5 years, if over 6, 7, 8 years EBITDA goes up 2.5, 3 times, we can still deliver a 20% IRR. That's going to be pervasive in the industry. Now, if you don't grow, keep growing, or if you have bad multiple contraction, if you pick the wrong businesses, you're going to have a lot of those 10% IRRs, and that's going to be bad. So, I mean, I can't remember what your question was, but that's what we think about that, every day right now when we're all under huge pressure to sell. It's tough to sell, and all of a sudden this 5-year period is 6, 7, 8, God knows what. What was your question?
DPI.
DPI.
You got it. DPI,
Okay.
IRR.
Yeah, IRR. I'll tell you a funny story, a quick story. So when I early started out in the business, there was a guy in New York, old Jewish real estate developer. He was in our fund, and I went to see him to raise a new fund. And I'm still giving my pitch, and I said, here's the IRR, and here's the MOIC, and here's the DPI. And he looks at me and he says, how much money have I given you? And I tried to do some mental math. You committed X, and I say $10 million. And he says, how much money have you given me back? And I looked at and I said, and I couldn't do the mental math. I couldn't figure it out. So he says, hold on. He picks up the phone. He says, Joe, bring in the sheet. And this guy comes in the room with one piece of paper, and he was like in 20 funds, and he had how much he had given us and how much we had given him back. And that's all he cared about. That's DPI. That's a businessman. But we live in a world of some investors want DPI, some want IRR, some want whatever. So we have to balance all that. But the IRR, at some point, you got to send money back, as this investor pointed out to me when I didn't have the answers to his questions.
Anne-Marie, let me turn back to you and be a little bit of a devil's advocate here. You talked a little bit about liquidity. You talk about partial sales needing to be fixed, some of the promise, but some of the pitfalls. As we think about IPOs, right, as a classic large cap exit, in my mind, the IPO is only a stepping stone to a full and complete exit, right? So how, as an investor, do you think about that, right? Oftentimes you go public, it's just a primary issuance, maybe a number of years before you can sell down in a consolidated fashion. And how do you think about the valuation questions when we're all positing somewhat the imperfection of the public markets and whether or not you're actually getting good valuations there as opposed from a portfolio of seasoned investors like we're sitting up here with?
Yeah. Let me take the second one first. I mean, we do worry. Look, the IPO window opens and shuts. Going back to what I was saying earlier, though, about private equity being a better governance model, it makes it hard for me to be really excited about public, using IPOs to exit if I don't think that that the market's going to function as effectively or is functioning as effectively as it has historically. So, but we do know that IPOs are going to continue to be exits. The things I would say there are, yes, we've all learned that an IPO is only the beginning of an exit process, not the end of an exit process. I will, one thing that maybe you all should be aware of is for us, when you make something go public, now it gets marked every quarter, right? And we have a public equity benchmark, so that actually introduces volatility for us and creates some performance challenges that we have to explain. Now, at the moment, it's not a big deal, but probably at the beginning of 22, when we had a lot of publics in our portfolio, and then during 22, they went down in value more so than the private equity benchmark did. So that's a challenge for us. And then the other thing I would say, is that we've observed, and I won't name the name, one of our venture portfolios, one of our venture funds had a portfolio, went public, and they refused basically to sell it. I think the GP really, or the partner at the GP really liked being on the board of directors, and so they just didn't sell it. And this is a tech company that had a massive valuation in 2021, and now I think is valued at like a tenth of what its peak was. And they just didn't sell. They sold some, but not nearly enough along the way. So the other thing I would say about the public markets is, in my experience, private equity guys are not that good at the public markets. And so if you're going to IPO, I trust you that it is the best exit, do it, but then get on it and actually get all the way out.
All right, Joe, we talked a little bit about different ways of exit, right? PE to PE trades, continuation vehicles, which we talked about a lot about. But you've often focused on, a new set of tools being out there to gather sufficient capital to provide exits and liquidity. So tell us a little bit about how you're thinking about things at Blackstone from that perspective.
Well, as it relates to the public markets, I think over long periods of time, we all suffer a little bit from recency bias, and recently public markets have been closed, and before that, you could sell anything at virtually any price, and it was like a party. But over long periods of time, the public markets have offered, a good place for liquidity. Public market investors have a lower cost of capital than private equity investors, and we've, over long periods of time, have probably over half our liquidities come from public markets. And I think that will return, particularly if you think about the fate of a public market money manager, and I don't know if anybody in this room does that for a living. If you don't own 7 or 10 stocks, you're not performing. I think those 7 to 10 stocks can't compound at 20% forever. Stipulate to that. So what are you going to do as a public money manager? I think buying really high quality portfolio companies from private equity where there's an IPO discount, and where when we sell, we're selling at a small discount, or sometimes not so small. I think that it has been and will continue to be in the future, I think, a viable venue for private equity liquidity. So I remain optimistic that market reopens and is there. In the meantime, you got to be creative, and our job is to return capital and to manage as high a net IRR as we conceivably can. And we're all doing what we can to be creative. I think there maybe was another question in there about the suitability of private equity for retail investors. If you look at the economy, something like 90% of companies are owned privately. There's a pretty small investable universe for public market investors. And I think it's completely appropriate for individual investors to have private equity as a complement to public equities. And now, with the industry having institutionalized and matured to such an extent, I think we can design products that's appropriate, that can be more fully invested, that can give access to individual investors to private equity assets, which in part could help solve some of the liquidity issues not for our own companies, but maybe for some other GPs. So I think capital markets innovate. I think the investment bankers in the room will agree with me that the public markets will reopen. When they do, I think we need to rethink how IPOs work. There's no reason, like in Europe, you can sell very large secondary stakes at the IPO. In some cases, you can sell the whole position. These are huge liquid markets. I mean, it's the biggest equity market in the world are the public markets. There's no reason that you only have to sell 10 or 20% of the company at the time of an IPO. If we're prepared to take the market clearing price and there's enough demand, we should be selling more at the IPO. So just a few musings that I don't know if I answered your questions or not. But
you did.
That was on my agenda. So.
You did, but you remember the question too. So
yeah.
You linked a few very interesting themes in here, right? Really, what you're talking about is, in part, on new sources of capital, the democratization of access to the private capital markets, right? We think about 90% of the businesses in this country are held in private hands, right? And we've talked already about the better governance model for private equity and how that drives over time consistently better outcomes and investments in public markets. Yet we've got a fairly limited amount of investors that have access into the private equity asset class. So just a little bit, tell me how at Blackstone you're thinking about that and moving forward. And look, that also ties into the key theme of the conference, right? Which is, a shared future towards prosperity.
We invest across multiple private equity asset classes, from life sciences to structured, opportunistic investments, to control private equity at the large end, to smaller cap and mid cap deals where we actually don't have an institutional fund to buy smaller companies, helping provide liquidity to other sponsors, helping recapitalize companies, good companies with poor capital structures. These are all things that the Blackstone platform are able to manufacture. And so we've created a vehicle that for retail investors that allows them to participate in all of that. And these are, I think you still need to be a accredited investor, but these are pretty small individual investors. So that is an innovation, and I know our friends at KKR have a similar vehicle and other larger managers. So I think that is something that will grow significantly. The percentage of alternatives in private equity in individual investors' portfolios is tiny, and it is one of the largest capital pools in the world. And it should have some exposure to the superior governance and everything else in private equity business models.
Excellent. Pete, tell me how you think about that at KKR.
Democratization?
Yeah.
So, yeah, and maybe I'll just address two things that are probably on people's minds. First, do you really need more capital? You've got the traditional institutional LP market, why do you need retail? And I would say for us, I feel like we've been short of capital for 20 years, for as long as I've been at the firm. If you go back 15 years, our North American fund was 17 billion, and today it's 19 billion. And over that period of time, as I said earlier, the S&P's gone up fivefold. And then again, you think about the equitization of capital structures today, our buying power is down like massively over the past 15 years. So what have we done? We've syndicated over the past 10 years alone, $38 billion of equity capital. And half of that has gone to institutions that are not even investors, they're not even LPs. We're just scrounging around trying to pull together the money to do deals. So yes, I think we have a very good use for the capital. The other question might be, what does this mean for traditional LPs? And to our mind, certainty of capital is valuable to our fund investors. So the fact that we're going to have a pool of capital alongside us to provide that certainty will make us more competitive in processes. So I think that's a positive. I also think a lot of our LPs don't want to own the same deal 5 different ways. So having a pool of capital, I think, is valuable. Our hit rate on co-invest among our LPs has not been that high, which is why we've gone to these third parties who are not even clients. And that's really what's going to get displaced with this democratized vehicle, which is the last thing I'll say. Our model, it's a co-invest vehicle. So everything that we do across 10 funds around the world that report into my partner and I, across US, Europe, Asia, flagship, core, mid-cap, and growth, a slice of everything goes into the democratized vehicle. So we're not cherry picking, we're not taking this deal but not that deal. There's total alignment, and it is, every single thing is going into the vehicle. So our LPs have gotten comfortable that it's really a very good source of co-invest and certainty of capital and can actually benefit our funds.
Terrific. Patrick, let's toggle back quickly from liquidity on capital raising back to liquidity on exits. We've had some conversations where you've talked about if you've got assets of sufficient scale, you think there's unique opportunities out the market, and I think you recently put up a very nice exit, so maybe you can give us a little perspective on that.
Yeah, I sort of feel like we need a better brand name for our firms, John, because we sort of sound like Jewish law firms, Leonard Green and Hellman and Friedman. So I'm sure retail investors are going to want to buy prenups from us.
I feel your pain on the law firm.
Yeah. Look, I think what I'm hearing from Joe and Pete ties a little bit into sort of my hope and expectation of the markets, which are private markets will continue to just institutionalize, and people will think about them as just investing in equity or investing in credit. Could be in the public markets, could be in the private markets, lots of different ways to do it. Could be investing in private equity through the public markets. So I'm sort of optimistic on that. We absolutely do need to get better at taking our companies public, Anne-Marie, and letting investors make money. But I think there's just tons of opportunity for the high quality things we own. SRS just sold for whatever, 18 billion. We just sold Splunk to Cisco for 30 billion. So you can get some really, really big things done at scale. And for high quality in the markets, equity, call them public or private, it's liquid. And so it's good.
All right, well, thank you. Well, we're getting short on time, and I want to cover 1 or 2 more questions. I'd like to ask each of you to give me 30 seconds on the 1 or 2 top opportunities or tailwinds that you see out there that are going to continue to drive high returns for the asset class. Joe, why don't we start with you?
Electricity demand in this country for the last, I don't know, a few decades has been 0%. It's now forecasted to be close to 3% for reasons we can all understand. The need for compute power, data centers, electric vehicles, the electrification of HVAC systems, what have you. Utilities, because there was zero increase in demand, have really not invested in the grid infrastructure, in the transmission, and obviously in power generation. And I see at least a decade-long mega CapEx cycle in the entire ecosystem around electricity in our country. And that's services, technology, software, picks and shovels, components. So it's not just infrastructure investing. And we're very excited about that, and we think we have a right to win in that area.
Patrick.
Look, I'm bullish on the opportunity to look at the public markets, because I think we've got a better governance model, and 25% of all public companies are 50% or below their high water price. So there's a ton of just, really great companies, but really bad stocks. So I think that's a super interesting thing. And then I think, as Pete pointed out, the opportunity set we have is way bigger than the capital base we have. So 8% of all capitalization in companies is in private hands relative to market value. And so there's a lot of opportunity in the public markets for our product.
Great. Jonathan.
Well, I'll answer your question a different way. People have referred to this exit we've recently had. So we did sell a company, or are selling a company called SRS to Home Depot for $18 billion. It's in their very glamorous business of distributing residential roofing products. You can't get more exciting than that. So rough numbers, it's $18 billion, there's $5 billion of debt, so it's $13 billion to the equity. 3 of the 13 is going to 9,000 employees of SRS, from the lowest levels up to the C-suite, and over half is going to rank and file. So as far as a better governance model, as a part of delivering better returns to Anne Marie, stories like this are wonderful stories, because, they're happy stories. We've changed people's lives. People getting anywhere, 500 people are getting $500,000 or more. Life-changing financial independence for these people. You buy your parents a car, you pay off your mortgage, you send your kids to college, whatever your dream is. A lot of these people are first-gen high school graduates, ex-military, ex-cons, so low-level people. So it's a great story, and we all have the kind of, broad ownership model that when it works, it's fantastic. And it's not just because it feels good, it's because it delivers better returns. So sometimes if you have the right ownership model and incentives and leadership motivation, and even an unexciting sector, you can deliver great returns for your investors and help thousands of people. And our industry continues just to be kind of reviled in Washington and in many aspects of the press. And there's a lot of stories like SRS out there that don't really get the light of day. So one of our jobs is to try to message those stories a little better, because it's an important part of what our industry does, and hopefully we'll continue to do.
That's outstanding. Congratulations on the investment, but congratulations on all that good creation for all those different people. Really well done. Let's stay with that a little bit in that theme, because I think that's a great transition and a place I'd love to end on. Again, coming back to the theme of shaping a shared future, we've talked about all the structural advantages of the asset class in the returns for investors. But part of what I think, Jonathan, you're talking about, again, is not just doing good while doing well, but also at the same time aligning the interests throughout the entire organization and all the constituencies in generating great returns and great businesses and having a positive impact on society. I think we all were lucky enough to watch Pete on 60 Minutes last night talk about some of the success that he's had. All the panelists asked me to thank you for warming up with the CBS production crew before you came to talk to us about this topic. But maybe you could walk us through the parts of your interview that dealt with ideation and policy making that invariably ended up on the cutting room floor, because like Jonathan said, doesn't make good TV to talk about ideas and policy and get into the wonkier side of things, but enlighten us a bit.
And maybe I'll start by picking up on what John said. So everyone's had these really blowout returns, and this is certainly one of them. And my observation is when you have these unbelievable outcomes, it's a lot less about competitive advantage and market position and barriers to entry, and it's more about culture. And certainly SRS had an amazing culture. And so it gets into what am I excited about? I'm excited about how do we identify people who build these great cultures and deliver these amazing outcomes. And it's just a continuation of what we're all supposed to be doing, which is finding ways to make good companies spectacular companies. And I think I'm excited about the increasing sophistication at which we are doing this. And so I'll maybe pick on another great investment that the Leonard Green guys have made. There's this company called Insight Global. It's a staffing business. So they do temporary staffing. They are taking folks who want to do some part-time work and marketing them to big companies who want part-time labor. And it's a terrible business. It's a terrible industry. How do you differentiate yourself? And yet here's this company that has gone organically, you can correct me if I'm wrong, over 12 or 14 years, this amazing leader has built a culture that has allowed this company to go from $40 million of earnings organically to $500 million, something like that. Yep. Organically, no acquisitions, in what I consider to be one of the worst industries I've ever seen. And so how did he do this? And this guy, Bert Bean, basically created a culture, this all sounds hokey, but where people live and die for the mission. The mission of the company is, we are the light in the lives of people trying to get a leg into the workforce. And people believe in it so strongly, he gets the best talent, they don't quit, and they're more productive, they're happier on the job, and they deliver better results. So what we're trying to do, we just stood up something we're calling the Human Capital Center of Excellence, and we want to try to identify the Bert Beans of the world who can do amazing things in some of the worst industries. What if we could perfect that and identify the psychological characteristics of people who can do that and then take them into even better businesses and better industries? So I didn't really answer your question. On the cutting room floor of the 60 Minutes piece was how do you take employee ownership and really scale this idea? There are many of us working on this at a nonprofit called Ownership Works. We're trying to be a clearinghouse for best practices on how to do something that sounds so easy and elegant. It is very difficult to create these ownership cultures, and it takes years. The part that they really cut was there's a public policy opportunity. There's something called an ESOP from 50 years ago. The government passed a law to give companies tax incentives to share stock with workers, like what the Leonard Green folks just did at SRS. That law holds tremendous promise. And there's a coalition of many, many employee ownership advocates coming together to say, let's drudge up this law from 50 years ago. Congress saw this problem coming, which was that stock ownership is going to create this huge wealth divide. Let's make this law actually effective, particularly among bigger companies. That's the way we're going to change the economy. As proud as I am of the work that we're all doing, that's not going to change the economy. We're going to maybe impact a couple million people, which will be great over the next 10 years, but we need like 50 million people to get ownership in their companies as a free and incremental benefit. And I think it's only going to be with government support we get there. We talked about this for hours in the interviews, and they said, that's the most boring thing I've ever heard. Public policy makes terrible TV because once you get into the guts of how do you drudge up this old law from 50 years ago and fix it, it's super technical. And so that all got cut. That was the most important thing. It killed me to see it get cut, but that didn't make it.
Oh, to Jonathan's point about making sure that we're all spokespeople for the industry and getting out there to talk about both the good things happening today, but the policy initiatives that are driving better future outcomes. Unfortunately, we are out of time. I could sit up here and talk to this panel all day. It's been a pleasure to be up here with each of you. It's been a pleasure to be in front of you. Thank you to all of our panelists for all of your time and thought, and it's been a real pleasure.
Thank you.
Thank you.
Nice to see you.